So, welcome, Carter. I see we have Angie on as well. Welcome, and Margie as well. So, welcome everybody. Today we have with us Carter Dempsey. I apologize if I get your title wrong. Director of Sales at Republic Bank.
Yeah, basically, I've got the independent program at Republic, but Director of Sales, TRS. That's correct.
Perfect. So, thanks for being with us today. So, I guess to start off, tell us a little bit about how the past year went for you guys. I mean, I'm very curious.
Well, so what's interesting is that, Ian, and this is a great opportunity to talk with you in particular, is we were really looking forward to be here to speak with you because you had a recent conversation with someone else where we kind of felt like there were some things that were conveyed that were at least not our experience or not what our take on what happened exactly was. So let's just kind of go through it.
Sure.
Last year, 3 stimuluses were received by March 28th. The second having been received on the first day of the pre-act, right? So for us, we saw a lower election in the advance and more people paid out of pocket. But this wasn't so much of a circumstance of being cost conscious as what we had heard, a week and a half ago. This was something that we saw as they had the financial means to be able to pay out of pocket, to not need to take the loan. So in the instance they were electing a free loan, it was really more out of, I don't really need the money, but if it's not going to cost me anything to get, then I'll take $500 or $1,000.
Basically, because they had the cash in their pocket from the stimulus, they didn't have a need for a big loan.
Right. So it just felt kind of counterintuitive to say that people were cost conscious in with respects to them receiving several $1,000s over the course of 3 months.
Now, one question though, does that correlate to lower bank product application as well, or are you talking specifically about loans?
So that's a great question. Per usual, it was both. So what we saw is that there were a lower election of advances based on being flush, and more people paid out of pocket. So many of the clients we spoke with, they didn't necessarily shrink in their client base. They had the same amount of clients, if not even more, because we saw a little bit of a transition from the DIY as well to paid prepare. I mean, it was complicated, right? People were afraid to do that themselves.
Sure. I mean, I saw one number that said that the pro prep side was up 22% year over year.
Right. Well, you have to also take into account that what they'd broken out in the previous year was for people that filed a return just for the purpose of receiving stimulus.
Right.
That number is incorporated, but then broken out on the back end. So that's not a true representation of the increased market, but still a good point. But it was just wild because we love watching these with you. You really do have your finger on the pulse and have a great brand. And we were hearing it and we were like, yeah, we don't quite think that's exactly what happened. 3 stimuluses having been received by the end of March, people were flush, which is an unusual circumstance. Typically, they can't wait to get their money or get an advance.
Right.
More people paid out of pocket. So that had an impact on bank products in particular. Well, now we're facing even another circumstance with the additional child tax credit. But, again, back to your original point, it did have more of an effect on bank products just based on them having access to cash that they hadn't normally had. So we think that there will be a resurgence this season, maybe not of bank products in general, but most definitely in the advances, because it's kind of like you get a taste. And let's face it, saving is kind of difficult when you don't have a lot of accessible income. So it doesn't necessarily mean that they're still flush. It has still been a challenging year. COVID isn't completely out of our lives. There are a lot of people still jobless, unfortunately. So what we find is that we do believe that people will tend to take advantage of the advances and they will take advantage of bank products. One of the things that we really wanted to convey outside of our normal PowerPoint that we provide, and so glad to have the dialogue with you rather than just read from a PowerPoint people can read themselves, was additional child tax credit. People need to be aware that ACTC is the EIP of 2022. So a lot of taxpayers, and I'm sure preparers are finding this out as well, when talking with their taxpayers, they weren't aware this money they were receiving as a whole, some are, that this was actually going to reduce their refund by the amount of half the child tax credit they received. I mean, let's be honest, 35 million people got this, only 1.8 million people opted out. So this is huge.
Right.
And not only is it going to reduce their refund, which affects their net refund for what loan they would get as well, it also is going to create an issue where many refunds will be delayed because they're going to get a letter 6419, and that amount has to match up to what's on the 8812. Well, how many people are going to go into offices? I didn't get a letter. I didn't get the advanced child tax credit. So what we've been made aware of, there will be an electronic method for the taxpayer to verify that many preparers will want to use or access to get that to make sure the number's right. Otherwise, refunds are delayed 6 to 8 weeks. It looks all like EIP and PYEI all over again.
Right.
So
I got to imagine there's going to be some, nefarious preparers who are going to say, down the street, oh yeah, no, I never got that money, but I can show you a bigger refund, right? And there's a guy down the street's going to say, I'll show you the bigger refund. That's going to get folks to go down the street without understanding why that person's able to give them a bigger refund, which is because they're claiming that the person never received the credit that they actually did receive throughout the year, right? And like EIP, like you said, that's going to basically hold the tax return until they're able to scrape off that difference and send out the adjusted amount.
The IRS, that is 100% accurate. Thank you. What the IRS has stated is if that amount does not match, it will, I think it's errors and omissions, but it will get pushed out and delay the refund 6 to 8 weeks. Preparers don't like that. We don't like that. Taxpayers don't like that. So taxpayers need to be very careful about that expectation being set. Tax preparers need to be very clear on the front end of what has affected their refund. They first need to make sure taxpayers are aware that that amount that they were receiving by check or direct deposit was in fact half of their child tax credit being paid in advance, and it will reduce their tax refund. They've been clear to also keep the letters that you receive for stimulus because it's possible that stimulus could also have an effect, but not to such a large degree as it did this past year. So,
do you expect that possibility of delayed funding will result in more folks electing to receive the loan?
I don't think they're going to have the expectation it's going to be delayed on the onset. I think if they knew that, then it absolutely would. I don't think people are going into it anticipating their refund's going to be delayed, right? They're used to, if they've got the child tax credit, then EIC, that it's coming typically February 22nd, because legally it can't come after February 15th, right? So that's when they're expecting it because their brother, sister, cousin, uncle gets it around that time, right?
Right.
So, it's a mixed bag, Ian. It's a mixed bag. Alternatively, one of the things that we take pride in, again, I don't like to reference too much some of the previous conversations you had to give everybody a chance, but kind of the reference as to the only bank doing certain things. We have programs for preparers. Granted, some of them are performance driven, where we have loans, entire programs up to $3,000, where it's free to the tax preparer or free to the taxpayer. The difference is we don't integrate those free options within a single loan program. The preparer chooses that program to begin with. So preparer says, hey, I want a program where I don't pay a dime for the advance. Or I want to choose a program where the taxpayer doesn't pay a dime for the advance. We just do those as programs and up to $3,000 because we feel like kind of intermingling those amounts within, it really kind of skews the approval and what people money are getting. Our average loan is extremely high. Our approval is really high. It's kind of what Republic's known for, is having the best loan out there. Mm-hmm. We want to be careful about the direction that we provide information to people to have them believe things that we don't think are really what drove the market behavior. Have people been cost conscious in the past? Absolutely. I mean, we've had people 25% of the time elect less than the amount they're eligible for because that's where they could influence cost. but that certainly wasn't this past season. I mean, it felt
Well,
like they were probably more flush than they've been in years.
I think you guys had the only program where you were able to elect the amount, you were able to elect how much you receive. So if anybody is able to see cost conscious, it would be you guys, because you could see that, all right, this person would have qualified for 6 and they only went for 1,000.
And that interestingly, last year that wasn't the behavior. Years prior it had been. So it's not that wasn't an accurate statement based on historically speaking. Last season it was just literally a matter of fact of, I don't need it. Now, if you were in the free option and the taxpayer was like, well, I don't really have to pay for it and I'm going to get it back, well, then they could leverage that as a choice. But really the question was, do I need a loan? Remember, the second stimulus was received by January 2nd. That was the first day of the pre-act. The third stimulus received at the end of March. If you noticed, more taxpayers filed in April that had refunds and forward than ever before, because they really just didn't need that money yet. So it was kind of like once they got through the time, because if you looked at filing and funding, the numbers were really odd in terms of the time frame. Usually it's really
very much so.
Right?
I think everybody can agree on that. Yeah.
So, and it was kind of shocking to us all, because we were getting calls and receiving applications much later. People were having checks to print. This month, people are still printing checks, and usually they're like, they maybe have 1 or 2 left.
Right.
So,
if the office isn't completely closed down, now these people are still going in every day.
So we feel like the market has gone a dramatic transformation. In that it's hard to put your finger on the pulse of exactly what is going to occur, but there have been a lot of changes that kind of dictate future behaviors that we haven't quite been able to ascertain because this is unique.
Right. So let me ask you this, Carter, and if we could pivot a little bit to the kind of the future. So what do you? 2 questions really, I guess. First one is, what do you expect for the upcoming season? And I guess the second part of that is, how has the Republic program prepared itself for that change?
Well, so here's what's really interesting. We are actually making very few changes to our program this next season, because kind of when you find the right mix of the offering that you have, you try not to mess it up. So we kind of found a place where our preparers were like, okay, these are the options we want. It's fine. I mean, of course, everybody would love to have the lowest price with the highest loan. Unfortunately, math doesn't work that way, but we did have an unintended benefit that we didn't expect going into this. So for Republic, our next season's loan is only as good as the performance of the last season. Well, funding for several years prior had been really, inconsistent, and it had an impact on our loan, not usually our approval. Our approval is usually rock solid, but our average loan. Now, our average loan is still light years higher than our competitors. I mean, I would challenge anybody to prove otherwise. It's just part of what we do so well, using our own money, being a bank, having our own model, kind of going through that in our own channel allows us to kind of stretch that. But because funding was later, but ended up actually being better, what's going to happen for us is our approval and our average loan will increase this next year for no change in price. So we're going to have the exact same price, the exact same amount of days that it's calculated on, but the average loan and the approval will increase because funding ended up being a little better by the end of September, which is typically when we look at our model.
If I could ask you that's an interesting statistic there. So if I'm hearing you correctly, that basically full year over full year, your overall funding percentage was higher than normal?
On the loans.
Just on the loans. Okay, gotcha.
Not necessarily RTs, right? You write your loan program as it relates to those where loans are provided, not necessarily RTs. So it's a good distinction, and thanks for making that. It does not mean that funding is apples to apples. It means with respects to loans, it was better. And we did have fewer elected too, so it's hard to say precisely what that reason is for. It just may be the right mix, right? But Again, one of the things that's really important too, with respect to that, where we don't really have to make a change, we already do better and people don't really realize it, is that our competitors disclose 25 days in their calculation but go up to 60, or disclose 25 and go up to 90 for the finance charge to taxpayers. And if you see that funding is so much later, what's happening is taxpayers are disclosed an amount when they sit down to get the loan, if there's a cost to it. And then when funding actually occurs, they're paying a much higher premium because funding's pushed so much forward. So we calculate at a fixed amount of days, right? And it does not change regardless of the amount of funding days. So yes, did we leave money on the table to not be flexible, to go to 60 or 90 days and only be at 32 versus the disclosed 25, but nobody really funds in 25? No, we were candid, and then it also affects that when taxpayers actually fund, that the loan fee they're being charged is exactly the same. So we kind of feel like we've already put our best foot forward. There are some things that we'll be rolling out more so the season after than this season, because it takes a long time to get in place and we're really excited about it. But for the nature of the way the industry's been, at least for the past several seasons, we feel very confident that we got the right product mix. We got the right approval and average loan. We really didn't need to make a change to that. We just want to branch out and offer some additional services, which we were not going to be able to bring within a given season. It was going to take us 2 seasons to get there. So for Republic, people using us, changing to us, they will see a higher average loan and approval rate than in the previous year. But the cost is not going to change at all. We're not changing it. We're also not stretching the wire on the, the amount of days funded, right? So
Right.
I know that's a little boring. I'm sorry. I don't have some, major, like, we're reinventing the wheel.
Right, exactly. No, that's perfect. I think for a lot of folks, that's actually going to be a breath of fresh air, that they don't have to relearn an entire new program and all the different intricacies and everything like that. I do want to ask a couple of just kind of housekeeping questions for those folks listening. Now, first, I believe this is true, and correct me if I'm wrong, but folks that are new to Republic, but not new to the industry, right? Say you've done bank products before at a different bank and you come to Republic, you guys don't treat those as brand new as long as that person's able to bring over and verify those records of their past bank product usage. Is that correct?
Yeah. We feel it's important to recognize the history that people have had. Now, granted, it has to be verifiable. We have gotten some information that we can't completely verify to indicate performance to be adequate, because for us, one of the reasons why we have the best loan is we do have some thresholds for eligibility in some of our more competitive loan programs. But if you have any experience and you can show us that experience, then by all means, we want you to have access to our products, the money that we can provide you. It's important, you have to be competitive. I mean, most people want to be competitive with the big box chains, right? And that's one of the reasons why people that come with us, we had a 97% renewal rate last year, Ian. And the main reason for that is that their loan is larger than Jackson Hewitt, Liberty, H&R Block. It's just they're competing with the big boys, and it's not their money, but it really reflects on them positively for people to be walking out with larger checks more frequently. So, but yeah, you're correct. Any history matters. We don't turn our nose up at anybody that's got some experience. Perfect.
I think that'll help folks that are thinking about making a switch but are hesitant. I know that's a question we get a lot. And folks don't realize that you can do that. My next question is for folks that are brand new to the industry, right? Never done a bank product, or at least never done a bank product under their own EFIN in their own office. What offerings are available for those folks?
So if they are associated with a group, I would say reputable group, although people would argue which group's not reputable. I mean, most are. Then we will allow them to have the EA in the first year. And it's really that they're getting the benefit of being associated with a reputable group, and reputable group saying, hey, based on our total performance, this new office needs it. And that's part of the reason why they're coming to us, because they can get something with us they can't get elsewhere, right?
So Sigma Tax Pro counts as a reputable group. So anybody that's a brand new
100%
can get the advantage. That was a little bit of a softball for myself. Thank you.
Yes. So if you are associated with Say Sigma, then coming on with them, you do get benefits that you don't get just as an individual preparer coming to the bank. Unfortunately, when you go, unfortunately, it's not meant to be disrespectful to the office, but fortunate for them, there are benefits to being associated with a reputable, strong player out there. So we also, we'll look at some of the money lending exceptions that we do differently, like the minimum amount of products that you have to get our preseason lending. Now, if you're brand new, you can't get pre-rep because you really don't have, which is our B2B loans, because you don't have any experience to show how much fees you had or bank products you had to pay that. But the in-season loan, we turn on for you fully, and we'll do up to $250,000. So once we get the act from the software, we'll send you 50% of your tax prep fee. Now, in your first year, we'll limit you to $600, right? Because we need to build experience with you before you send in returns that are $1,200 and expect $600 in half.
That's $600 in revolving door credit, right? So as you pay,
right. So
you're able to borrow against it again.
Right. That's absolutely correct. But once you've been with us at least one season, then we do the full 50% of the tax prep fee, regardless of what that tax prep fee is. And it's up to $250,000. Every once in a while, I have to raise limits, but considering the time frame that it's done in, it is, it usually works for most. The other thing is that we are delaying our 100% collection until right before the PATH Act funding. A lot of people were like, "Hey, listen, you're starting to take all my money before the big one hit. Can you at least get it closer to the big one so you're not just wiping me out?" Because they're great when the money's coming in.
Mm-hmm.
When you take it, they're like, "What are you doing?"
Let me ask you one about that, because that's actually a really good point that I want to clarify. So traditionally, the more products a person has, the more money a person's borrowed, right? So let's say, for example, an office has a preseason loan that they've taken out from you guys. They also have the in-season fee assist, right? And I apologize if these aren't the exact names that you guys use, but I think industry general terms. They have an in-season fee assist that they are using, maybe a few $1,000s, whatever it is. And they've also offered a number of pre-acknowledged taxpayer advances, right? So you can see how the debt to Republic is stacked up pretty high. Does the increase in those debts, does that in any way change the collection time? Right. So if it's like, all right, we'll take 50% of your prep fees to pay back your preseason loan, but we're also going to take 50% of your prep fees to pay back your in-season loan. Well, now you're taking back 100% of the prep fees. Do you know what I mean? I know reconciling all that can get confusing to folks.
Right. So no, when we say 50%, we try to group it together because we realize that they need that trickle, right? Some offices only have 20% of the total returns they're doing as bank products, so they're receiving enough to pay out of pocket that taking just the bank product money isn't as much of a challenge. But for those that are like 100% bank products, it's their lifeline. So we do 50% for the wrap, pre-wrap. For EA fees, those typically don't kick in until a little later, right around the PATH Act funding. So it's usually most people are kind of caught up around the PATH Act funding other than loans that they've done from that period. But software purchase assistance, if you get SPA, that comes out right away. Now, it's only up to $2,000, but that is something that hits quickly. But depending on your office makeup, it can still be painful. I mean, if you're 100% bank products, every single person you do is paying you from the refund through the bank, then it can still be challenging because most of the taxpayers for what we're doing are earned income credit and additional child tax credit, and those aren't funded till February 15th. So you're getting state fundings, right? And those are typically much smaller. So I hear where you're going. We have accommodated for it, but does it look ideal? It depends on your office makeup.
Right. That's always a challenge with every year with every office for us, especially like you said, the people who are 100% bank product, they need a program like the in-season fee assist. They need that worse than anybody because they don't have any money, right? They open their office in December and they don't have a single dollar in revenue coming in until basically the end of February. So unless you got the money to float 3 months worth of payroll and rent and all that overhead, then you need a preseason loan. You need the in-season fee assist. And you need to be offering a pre-act loan to get folks in the door early. But then when it comes back time to reconcile, it can get a little bit messy. So it's just always something to be aware of, I think, when folks are electing for all those products to keep a close eye on what you're getting, and remember that when the end of February does hit, there might be some lean payments coming in because you've already borrowed against that money so heavily.
Yeah, it's a astute observation. And I loved giving you the softball too, man. That was kind of fun.
Yeah.
Here, shameless plug, go.
Right, exactly. Yeah, I got to work them in somewhere. Still a sales guy at heart.
Oh yeah.
That's awesome, Carter. Well, before we wrap it up, do you guys have anything else that you want to say to anybody that we haven't already covered?
I mean, I just need to reiterate something that's important. Everybody has their preference towards certain partners, either for that history, that relationship. Sometimes it's the uncertainty of change. The one thing that, and if I'm being honest, most of the bank products do many of the same things amongst the different banks. There's little differentiation between how we deliver those services. I do know that there's some additional services coming out this year. We toggle a little bit with that because of the impact to taxpayers and long-term use of that client. Won't be more specific than that. But what's so important to relate about Republic is one of the things that really sets us apart is we really just have the best loan. Nobody can really touch our loan, and they make claims, but we do the data with all of the partners. We talk with all of the major groups. We look through it. And granted, a first-year office, it can be more challenging because you don't have that taxpayer history. But once you've built up any level of history at all, or you've had that taxpayer in the previous year and are using the same software where that's sent to the bank initially, our loan is banging, and that matters. We tend to think that taxpayers are going to elect more this year because there's not stimulus coming. Refunds will be down because of additional child tax credit. So that's one of our fortes, and it's something that you should consider.
Okay, awesome. I think so. I think I agree with you there. Now, Carter, last thing, if folks want to get in touch with you guys, Republic Bank, they want to ask more questions, or maybe they want to make the switch, how can they get in touch with y'all?
So 888-676-2056 is our general kind of sales number. When you call that, we obviously will provide you emails as well to have interaction. You don't just have to call. In the PowerPoint that'll be on the on-demand, which I think we agreed that one people thing have been sick of over the years is going through and having someone read through a PowerPoint they can read themselves. They just really want to know what's different or changed from the previous year. So I appreciate having this dialogue with you. There will be our email addresses and that phone number on the last slide as well. So get that to you to get you posted. And thanks for giving us the opportunity to have a dialogue as opposed to just let me read this line in a monotone voice. So
right, exactly. You can play that when you're trying to go to sleep at night. That nice voice. That's perfect. Yeah. All right. Well, thank you so much for being with us, Carter. We really appreciate it, and best of luck this tax season to you guys.
Thanks, man. Appreciate it.
See ya.